Hello and welcome to a policy brief. This is a new segment of the show called Policy Pulse. It's a weekly review of global policy shaping our world. We're going to start from the beginning of June to the 19th or 20th, which is when this is being recorded. And we're starting off with 8 critical developments. And these are topics that we deem important. And they represent a significant fundamental shift in how governments, central banks, and international institutions have responded to interconnected challenges. And I'd say we are witnessing unprecedented policy innovation and coordination. And I say it demands systematic analysis and review. And that's why we are covering these 8 topics today. All right. So we are kicking off with the first topic being a Bloomberg article that says the IMF sounds stagnation alarm on Eurozone economic growth. Now, like I said, the IMF on the 19th of June have delivered its most direct caution yet about the European economic prospect, and they suggest that Europe risks drifting into stagnation without urgent action. And the Eurozone, according to the IMF, is projected, and the article is projected to grow at about 0.8% in 2025, despite achieving record low unemployment and inflation being near target levels. And the IMF, in the article, identified extraordinary internal barriers. And according to them, there exists fragmentation within the EU, and that creates costs that are equivalent to a 44% tariff on goods and a staggering 110% tariff on services. Now, let's just pause there and consider that we have the trade uncertainty that has been happening with the US issuing tariffs on a host of countries, but this is within the EU itself, and this is what the IMF is pointing out, that forget the tariffs that you're seeing from the US. This is exactly what's going on because of existing fragmentation within the EU. So moving on from that particular point, they're basically just saying that Europe is imposing protectionist measures on itself through regulatory and market fragmentation, which is bringing about a tariff on itself, within itself, of 44% for goods and 110% for services. So what are the solutions? And the IMF in the article, the Bloomberg article, says that they recommend 3 bold initiatives. First being deepening the single market through regulatory harmonization, capital market reforms, and enhanced labor mobility. Increasing the EU's budget by 50% to fund shared objectives like defense, aging populations, and climate resilience. And accelerating capital market union to facilitate cross-border investment flows. The potential impact is substantial, according to the IMF. Closing these fragmentation gaps that they've identified could boost GDP by 3% over a decade. It represents a 450 billion euro additional output for a $15 trillion economy. And I see that's quite significant. The IMF specifically advocates for a 28 regime, and that's a voluntary EU-wide corporate charter allowing companies to operate under unified rules rather than navigating 27 different national regulatory systems. And when I read through this, I had 3 policy questions. And the first being, to what extent does internal market fragmentation truly hinder Eurozone economic growth? And are the IMF's proposed solutions politically feasible, given the diverse interest of member states? And second question I had is, what are the potential risks and benefits of increasing the EU's budget by 50%, particularly concerning fiscal discipline and the allocation of funds for shared objectives? Third question, how will the 28 regime impact national sovereignty and regulatory autonomy? And what mechanisms would be necessary to ensure its effective implementation and widespread adoption by corporations? Now, with those 3 questions, I decided to, try and analyze what I think, would be feasible given the IMF's recommendation. And the IMF's warning about the Eurozone stagnation highlights a critical challenge that I believe, and what they noticed was a persistent gap between theoretical benefits of a single market and practical realities of its implementation. That's, sort of, it's theoretical, but what's the practicality of implementing these recommendations? The estimated cost of fragmentation, according to the IMF, is 44% tariff on goods and 110% tariffs on services. These are indeed staggering and significant, and they underscore a significant drag on economic potential of the EU. Now, this fragmentation is not merely a technical issue, but a deeply political one. And I think that's what we need to take note of. And it's rooted in national regulatory preferences, historical legacies, and the reluctance of member states to cede further sovereignty. The IMS proposed solutions of deepening the single market, increasing EU's budget, and accelerating the capital markets union are economically sound, but yet again, they face considerable political hurdles. Deepening the single market requires overcoming entrenched national interest and harmonizing diverse legal and regulatory frameworks, a process that I'd say has been historically slow and contentious. Increasing the EU's budget by 50% would necessitate a significant shift in fiscal contributions and priorities, likely encountering resistance from net contributors, states that seem to contribute more. And therein lies the question, how then is this, it's a good recommendation, but how feasible is this? And, the third recommendation that they had of the 28 regime, I'll say the concept of 28 regime, while it's innovative, it attempts to bypass national complexities, and it raises fundamental questions about the voluntary nature. It raises questions, I say these questions are quite fundamental about the voluntary nature, and is it voluntary, or a nation's compelled to do this? And that remains to be seen whether it gets traction from member states. And the success of these proposals, it hinges not just on economic merit, which I think this is sound and has economic merit, but on the political will and capacity of the leaders of member states in the EU. It requires them to come together and forge consensus and implement these reforms. And that may be unpopular domestically in certain countries. And while I think, the economic benefits from the article, the recommendation that they put forward, they're quite clear and they seem sound. However, I do think, the process to achieving, these particular recommendations are fraught with political complexities, that the IMF probably haven't addressed in their article. And by nature, it's not their place to address them. So we move on to the next topic. Second topic being the ECB's rate cut. And I'll say it's pretty strategic monetary policy that we witnessed. All right. So still on monetary policy, the ECB, according to the central bank president, Christine Lagarde, they delivered an 8 consecutive rate cut. And this happened on the 5th of June, thereby reducing their key deposit rate by 25 basis points to 2%. And, this isn't just routine. It reflects a fundamental reassessment of Europe's economic trajectory amid persistent growth challenges. Now, the ECB updated economic projections show concerning trends. Inflation averaging 2% in 2025 before declining to 1.6 in 2026, with growth forecasts remaining constrained at 0.9% for 2025. The IMF thinks it's 0.8. The president, Christine Lagarde, specifically cited, that uncertainty surrounding trade policies are weighing, on business investment decision, and that's typically what happens. What's particularly pronounced, or will I say, what particularly sticks out here is the policy divergence between the ECB and the Federal Reserve, and we'll come to the Federal Reserve in a bit. Now, while the ECB pursues aggressive rate cuts, despite inflation being near target of 2% in the medium term, the Fed remains restrictive because they held policy rates, and we'll come to that. Now, with inflation well above, objective levels. A fascinating, how I put it, contrast, indeed, in terms of what that looks like. And so, moving on with that, the policy questions, that the key policy questions for me, when we consider this, is what are the primary economic justifications for the ECB's continued aggressive rate cuts, especially when inflation is near its target? And what are the potential long-term consequences of such a policy of financial stability and, asset bubbles? Also, how does the ECB's policy divergence, especially when you consider the Federal Reserve's impact on global capital flows, exchange rates, and competitiveness of the Eurozone's export, and what are the implications for international monetary policy coordination? Third policy question, that I had was, giving President Lagarde's concern about uncertainty surrounding trade policies, to what extent can monetary policy effectively counteract the negative effects of geopolitical and trade-related risks on business investment and economic growth? Now, for the policy analysis, regarding my policy questions, I'd say the ECB's decision to implement an 8th consecutive rate cut, even with inflation nearing its target, signals a deep-seated concern about the Eurozone's growth prospects. This aggressive easing strategy is primarily driven by persistent low growth forecast of 0.9% for 2005, according to the ECB, and the acknowledgement that demand-side pressures remain weak. The ECB appears to be prioritizing growth stimulation over a strict adherence to its inflation mandate, perhaps fearing a slide into deflationary pressures or prolonged economic stagnation. However, this approach carries inherent risk. Prolonged periods of low interest rates can inflate asset bubbles, encouraging excessive risk taken by financial institutions. Part of the questions that I believe a lot of people had, being that, it seems like, they were at the target, for inflation. Are we about to see, really low interest rate regimes? Or perhaps are we looking at more rate cuts and flirting with negative interest rates? So people sort of had these questions, but I like how, President Lagarde sort of handled it and kept forward guidance on point. Right. So back to where we were. Yes. So the divergence from the Federal Reserve's more restrictive stance is particularly noteworthy. While the Fed grapples with inflation well above its target, the ECB is cutting rates, and it's creating a significant interest rate differential. This divergence can lead to capital outflows from the Eurozone, weakening the euro against the dollar, which could make the Eurozone export more competitive, but also increase import cost. The lack of synchronized monetary policy among major central banks can introduce volatility into global financial markets and complicate efforts at international economic coordination. Furthermore, I think it's also important that, President Lagarde emphasis on trade policy uncertainty rather, highlights a limitation of monetary policy, because monetary policy isn't quite a silver bullet as certain people like to think. It does have its limitations, and it's less effective in addressing supply side shocks or geopolitical risk that put a dampening pressure on, business confidence and investments. Now, while lower interest rates can reduce borrowing costs, they cannot directly resolve trade disputes or geopolitical tensions that create uncertainty. Now, the ECB's actions, therefore, represent a calculated risk, and that's sort of what all central banks have to do. You take calculated risk based on data, aiming to shore up a fragile economy, but one that must be carefully balanced against potential financial stability risk and the limitations of monetary policy in a complex global environment. The next topic would be a fascinating find that I found when I was just going through Financial Times. It's Afreximbank versus Fitch rating, and there was some institutional dispute, and we see it's what entering into institutional dispute between Afreximbank and Fitch. And what we have here is quite important because it reveals fundamental flaws in how credit rating agencies, how they assess multilateral development institutions. The disagreement between the African Export-Import Bank, or Afrexim, and Fitch Ratings came to a head, became, quite serious just by reading this. Just to provide a quick summary of what exactly went down. So Fitch, I believe on the 4th of June, downgraded Afreximbank from triple B to triple B negative. So it placed the institution, as Afrexim, just one notch above non-investment grade status. And, if you're familiar with financial market and fixed income, you quite understand what that means, what a downgrade means. It's harder for you to, get financing by selling your bonds. The credit spread on your bonds sort of widens. It's quite bad. So the core, the core of the methodological disagreement centers on the non-performing loan calculations by Fitch, and Fitch estimates 7.1%, while Afrexim reports 2.44% under the International Financial Reporting Standards. And you would expect, but Fitch, I believe, are trying to look forward and trying to see between what some might say would be the proverbial tinted glass, right? And that's supposed to be what that ought to be what they're supposed to do as a rating agency. However, but there's a misunderstanding. Now, we have the African peer review mechanism. It's part of the African Union, and they characterize the Fitch report or the Fitch approach as being flawed, and it's based on a misunderstanding of the treaty behind the institution. So the structures that are backing institutions like the Afrexim, and there's a treaty that the Afrexim have with the member states. I believe there are 53 of them. So the controversy highlights the urgent need for multilateral development banks and their specific rating criteria that these credits reporting agencies are supposed to use to provide a proper account for the preferred creditor status that Afrexim has with and the sovereign guarantee that comes with that particular status. What I understand by this is they're saying that because Afrexim has preferred creditor status from the treaty, sovereign guarantees, and their callable capital structures that are unique to multilateral institutions, development policy mandates that differ from commercial banking. And that's probably maybe what Fitch was looking at. This African peer review saying, no, you can't look at a development bank that has a treaty backing it, giving it preferred creditor status like you're looking at a commercial bank or a private lender. And these are some of the issues, especially for financing on the African continent. So while looking at this, I had my policy questions. What are the systemic implications of a credit rating agency using a methodology for multilateral development banks that is perceived as flawed or misaligned with the multilateral development banks' unique operational and legal framework, right? Second question that I had was, how are the international financial, how can the international financial architecture be reformed to ensure that, multilateral development banks are assessed fairly and accurately, reflecting their development mandates and unique risk mitigants without compromising the independence and credibility of the credit rating agency, such as Fitch and their peers. So third question that I had was, what role should regional bodies such as the African Peer Review Mechanism, which is part of the African Union, play in challenging and influencing methodologies of global credit rating agencies, and when their assessment impacts the financial standing and development capacity of African institutions. And I'll say, considering my questions, I do think that the dispute between Afrexim and Fitch, or Fitch Ratings, is more of a mere, how do I put it, accounting disagreement. It exposes, and because Fitch treated it a certain way, while Afrexim treated it, different way with their preferred creditor standing that they got from the treaty that they have with their member states. So it exposes a fundamental tension in global financial systems regarding the appropriate assessment of multilateral development banks, credit rating agencies designed primarily to evaluate commercial entities often apply a one-size-fits-all methodology that fails to capture the unique characteristics of profiles of multilateral development banks. These multilateral development banks and institutions like them, they're not commercial banks, and they benefit from preferred creditor status. They also benefit from callable capital from sovereign shareholders and treaty-based legal protections, all of which significantly reduce their credit risk. When credit rating agencies like Fitch or Moody's or whatever, do not adequately account for these factors, their ratings can inaccurately portray these multilateral development banks as riskier than they are, and in leading to high borrowing costs. Like I mentioned, if you downgrade an institution, obviously they're going to raise capital at a higher rate, right? This in turn can impede or make it harder for these institutions to mobilize capital, like I mentioned, for critical development projects, particularly in regions like Africa, where they serve, especially for Afrexim. And it does make development finance a little bit harder. The systematic implementation is a potential, how I put it, misallocation of global capital, where essential development initiatives are starved of affordable funding due to methodological blind spots in how the credit rating agencies treat the credit risk of these institutions. Now, reforming the international financial architecture to address this requires a multi-pronged approach. It necessitates dialogue between the credit rating agencies, the multilateral development banks, and international financial regulators to develop a framework, for the multilateral development banks and institutions like that are very much like them, that have preferred creditor status. And once that framework is created, we should see less of these occurrences. And this could involve creating new categories within rating methodologies or establishing independent expert panels to review ratings for these institutions. The role of regional bodies like the African Peer Review, I'd say it's quite vital in this particular context, by providing a collective voice and evidence-based critiques that can challenge flawed methodologies and advocate for reforms that better serve the development needs of their respective regions, ultimately ensuring fair and accurate assessment of multilateral development banks is not just about institutional reputation, which is important. It is also about enabling these critical institutions to fulfill their mandates of fostering sustainable development and poverty reduction globally in the regions that they serve. However, I do quite understand the position that the credit rating agencies are in, because I did do a quick search in terms of, Afrexim and Ghana and South Sudan. And I did find conflicting reports from, where they were supposed to have preferred creditor status. And I think there were quite a few instances where it seemed like they had gone to court and things like that. And I do understand, the complexity of these things. But that's why I believe this is important, where light is being shown on these issues so that we can sort of have reform in this regard. Our next topic is the World Bank's economic assessment. It's the global economic assessment. Now, the World Bank's June assessment delivered perhaps what I would say is the most sobering economic forecast in recent memory. And they're projecting, for 2025 as, going to have like the weakest non-recessionary growth year since 2008. Now, the global growth projections have been revised, according to the World Bank, downwards to 2.3%, representing nearly half percentage point reduction from January's forecast. And, just put a pause here. This, so that if you consider this, and the first thing we talked about being IMF's alarm for stagnation in the Eurozone, and this is what the World Bank sees globally. And then you also, consider this with the backdrop of the geopolitical tension that's going on in the Middle East and with trade policy tensions globally, with the US and, most countries globally. You then start to have a very bleak future for economic growth globally. So I just move on with, the content of the assessment. The scope of this economic deceleration, according to the World Bank, is unprecedented. 70% of global economies across all regions and income groups are experiencing downward growth revisions. Chief economist in the MIT, Gail Stark, assessment noted that outside of Asia, the developing world is becoming a development-free zone. And, they noted that structural economic data reveals a fundamental transformation in global trade patterns, with growth declining from 5% in the 2000s to less than 3% in the 2020s. According to the economic assessment, if current forecasts materialize, the 2020s will represent the slowest decade of economic growth since 1960. And it's a truly concerning outlook. The key policy questions from their economic assessment for me are what are the primary drivers behind the World Bank's pessimistic global growth forecast for 2025? And how do these factors differ from previous periods of economic slowdown? Also, what specific policy interventions beyond traditional monetary and fiscal measures are necessary to reverse the trend of declining trade growth and prevent the development-free zone scenario in the developing world outside of Asia? Also, how should international development institutions like the World Bank adapt their strategies and funding priorities rather to address a prolonged period of slow global growth and ensure that development gains are not eroded, particularly in vulnerable economies? Now, to analyze, my questions, I think that the World Bank's green forecast for 2025, projecting the weakest non-recessionary growth since 2008, that scores a profound shift in the global economic landscape. And I'll say this slowdown is not merely cyclical, but appears to be driven by deeper structural factors, including persistent geopolitical tensions, like I mentioned, supply chain disruptions, high inflation, and the lingering effects of the pandemic. Unlike previous downturns or slowdowns, where recovery was often spurred by robust trade or technological innovation, we might get because of AI, but let's put AI on pause for now. The current environment is characterized by significant deceleration in global trade growth, a trend that began even before the recent crisis. The decline from 5% in the 2000s to less than 3% in the 2020s suggests a fundamental reordering of the global economic relationships and a potential retreat from globalization. The World Bank's chief economist in the MIT, Gill's, very significant stark observation about the developing world outside Asia becoming a development-free zone is particularly alarming. If you consider it, it implies that many low income and middle income countries are struggling to achieve sustainable development, facing challenges such as debt distress, climate change impacts, and limited access to capital. Now, traditional policy interventions, while necessary, may be insufficient to address these multifaceted challenges. Beyond monetary and fiscal policies, There's an urgent need for structural reforms that enhance productivity to foster innovation and build resilience against external shocks. Now, these include investments in human capital, infrastructure, and green technologies for international development institutions. This forecast, by the World Bank demands, I'll say it should inspire a reevaluation of these strategies, and it should help them, prioritize support for countries most at risk, focusing on tailored solutions rather than generic solutions that address specific vulnerabilities. And these might involve or include innovative financing mechanisms, debt relief initiatives, and enhanced technical assistance to build institutional capacity. The challenge is quite immense when you really consider, what this report is suggesting. It's quite serious, and a prolonged period of slow growth could make worse, the poverty and inequality and social instability that's prevalent in these parts of the world. And it definitely makes the World Bank's role in advocating for and facilitating effective policy response more critical than ever right now. Success. Now, shifting gears to a remarkable turnaround story. Argentina achieved a significant economic transformation under President Javier Milei's administration, with monthly inflation declining to 1.5 in May 2025. It's the first sub 2% reading since 2020. This represents a dramatic collapse from the devastating 25.5% monthly inflation rate recorded when President Javier Milei assumed office. The moment I saw this, there was an article I saw on Bloomberg where it was talking about how Argentina achieved sub 2% monthly inflation. I was shocked. I was like, wow, I knew, things were going in the right direction. But this is a country that's had probably the highest level of inflation in the world at some points. And to get inflation down to those levels, I think it's something worth calling attention to. So countries that have problems with persistent inflation can, sort of learn something from the journey that Argentina has been on so far. Now, the stabilization strategy centered on three orthodox economic pillars. One, freezing the money supply to prevent central bank deficit financing, implementing massive fiscal consolidation to achieve primary surpluses, and eliminating the peso crawling peg system. Annual inflation has declined from peak levels exceeding 200% to 43.5% by May 2025. However, this dramatic inflation reduction has come at significant social cost, as is expected, with poverty rates spiking to 53% in 2024 as currency stabilization and fiscal austerity measures compressed economic activity. The sustainability challenge involves managing the transition from stabilization to growth while maintaining the hard-won anti-inflationary credibility. I like what I'm seeing with these inflation numbers for Argentina. Now, the key policy questions that I have, when I consider this is, what are the long-term implications of Argentina's orthodox stabilization strategy on its economic structure, particularly regarding the sustainability of fiscal surpluses and the potential for renewed inflationary pressures once the growth policies are pursued? Second one being, how can Argentina mitigate the severe social costs, such as rising poverty rates associated with its stabilization program? And what policy tools are available to ensure a more equitable distribution of the benefits of economic recovery? And third and final question for me would be, to what extent can Argentina's experience serve as a model for other countries grappling with hyperinflation? And what are the critical preconditions or unique circumstances that might limit the transferability of its stabilization success? Argentina's dramatic reduction in monthly inflation under President Milei's administration is a remarkable case, honestly. It's a remarkable case study for people who love economics and, people who would love to tackle inflation in an orthodox economic stabilization sense. Now, the core of his strategy of freezing the money supply, aggressive fiscal consolidation, and eliminating the crawling peg directly addresses the root causes of Argentina's chronic inflation, which would be excessive money printing to finance fiscal deficits. The rapid decline in inflation from 25.5% to 1% monthly is a testament to the effectiveness of these measures in restoring macroeconomic stability and rebuilding credibility in the central bank. However, this success has come at a significant social cost, and that's rightfully so. Like, if you're going to focus on austerity, there's going to be, people, feeling the pinch in the pockets. The sharp contraction in economic activity, a direct consequence of fiscal austerity and currency stabilization, has led to a dramatic increase in poverty rates, reaching 53% in 2024, and that's a significant number, 53%. This highlights the inherent trade-off between rapid disinflation and social welfare, particularly in economies with deep structural imbalances. I'll say that the long-term sustainability of this particular stabilization hinges on Argentina's ability to transition from austerity, where they're at now, to sustainable growth without reigniting inflationary pressures. And, I'm really rooting for them to achieve that. And I think they will, with how far they've come. This requires careful management of public finances, also requires attracting foreign investment and implementing structural reforms that boost productivity and competitiveness. The challenge lies in maintaining fiscal discipline, rather, while simultaneously addressing the urgent social needs of the population. For other countries facing hyperinflation, Argentina's experience offers valuable lessons on the importance of decisive action and credible commitment to orthodox policies. Because sometimes you just think these policies don't work, but if you're not as decisive as they've been and credible to committing to those policies, you might not achieve the results that they have. However, the transferability of this model is not without, I would say, some caveats. Argentina's unique political and economic history, with things like inflation, also including a deep-seated distrust in its currency and institutions, may have made its population more receptive to radical measures. Because usually when new governments come and you talk of austerity, sometimes you might not have the buy-in of the populace. And I think, that's something that Argentina has had, and it's made this policy stance quite successful. Furthermore, I think the social tolerance for austerity measures can vary significantly across countries, like I mentioned. And depending on the social safety nets and political stability that's available in the country and the perceived legitimacy of the government. Now, therefore, I would say that while economic principles applied in Argentina are universally relevant, the specific implementation and, of the policies with the backdrop of, the social and political context is quite important and must be considered if you want to sort of imply or apply, the strategies that Argentina have taken, to sort of address inflation in certain countries. Moving on to our next topic, being the Federal Reserve's policy framework. We're back to looking at central banks. And the Federal Reserve June 18th decision to maintain rates at 4.25 to 4.5% marked the fourth consecutive meeting without an adjustment, and it reflects a heightened caution amid economic uncertainty. Dated economic projections reveal a more pessimistic outlook. GDP growth, has been revised down to 1.4% for 2005, while inflation projections increased to 3.1%. As we touched upon earlier, the divergence between the Federal Reserve and the European Central Bank policy approaches then now becomes particularly striking, when examining their different economic environments and policy responses. The Fed maintains restrictive policy despite strong labor market conditions, while the ECB pursues aggressive easing despite achieving inflation targets. The policy framework evolution, I'd say, demands innovative approaches, including flexible average inflation targeting through 2 to 3 year rolling averages, enhanced communication via things like scenario-based forward guidance, and strengthened international coordination mechanism. And I do say this: central banks, as long, for a lot of times, we don't quite hear a lot of what they do, even though there's sound forward guidance, but they do coordinate amongst themselves. They do speak to each other. And I think that's something that sometimes doesn't get talked about a lot. Now, so the key policy questions, with the Fed maintaining rates as they are. First, before I talk about my questions, I also like to just point out that the Fed has a dual mandate of maximum employment and price stability. However, the ECB does have the one of just inflation, and that's something that sometimes people tend to forget. So the Fed does have to do like a balancing act between maximum employment and inflation. So the policy question that I have when I went through, what the Fed did was, what are the primary factors driving the Federal Reserve's cautious approach to interest rate adjustments, particularly given the strong labor market and what are the potential risks of maintaining a restrictive policy stand for an extended period? However, how does the Federal Reserve revised economic outlook? Because they always, if you listen to, Chair Powell, he was always talking about the data, always looking at the data. So what's the revised economic outlook? How does the revised economic outlook with lower GDP growth and higher inflation projections influence the dual mandate of maximum employment and price stability? And what trade-offs might be necessary in its policy decisions? Also, in what ways can the Federal Reserve enhance its communication strategies, such as through scenario-based forward guidance, to manage market expectations and reduce economic uncertainty, particularly in an environment of divergent global monetary policies? Because a lot of market participants are starting to ask the question: is inflation truly anchored? And you start to have this kind of dialogue in certain spaces that are quite important. Analysis of for my question, I would say the Federal Reserve decision to hold interest rates steady for the fourth consecutive meeting, despite a robust labor market, signals a cautious and data-dependent approach to monetary policy, which I'd say is quite sound. This caution is primarily driven by persistent inflationary pressures, such as evidenced by the upward revision of inflation projections to 3.1% for 2025, and a more pessimistic outlook on GDP growth. The Fed is navigating a complex economic landscape where the traditional Phillips curve relationship, that's the trade-off between inflation and unemployment, appears to be less clear. Right? While the labor market remains strong, the risk of inflation, it's becoming entrenched in a significant, and it's becoming, something that's given the Fed significant concern, leading to the Fed to prioritize price stability, which is the inflation part of their mandate. However, maintaining a restrictive policy for too long carries its own risk. But you have to sort of understand where the Fed is at. We have a lot of uncertainty coming from tariffs in the US. We have uncertainty coming from geopolitical issues with the US and globally. So you sort of have to understand the unique position the Fed is at. Everybody's calling for rate cuts, and it does appear like, they should be cutting. But you also have to look at the data, so that's where the Fed is at. How, like I said, back to where I was, like, maintaining restrictive policy for too long carries its own risk, including a potential slowdown in economic activity. Increased borrowing costs will probably could happen if you maintain rates for higher for too long. For businesses and consumers, it could lead to a possible recession. The market participants that are starting to, predict that we might have a recession in the second half of the year. And, like I mentioned, the divergence from the European Central Bank's aggressive easing strategy further complicates the Fed's policy decisions. This divergence can lead to capital inflows into the US, strengthening the dollar, which can make the US export less competitive and imports cheaper, potentially easing some inflationary pressures, but also impacting domestic industries. The Fed's dual mandate of maximum employment and price stability requires a delicate balancing act, like I mentioned. In the current environment, it appears the Fed is willing to tolerate a slightly slower growth trajectory to ensure inflation is brought under control. To manage the market's expectation and reduce uncertainty, Fed can enhance its communication strategies. Scenario-based forward guidance, for instance, could provide clearer insights into the Fed's reaction function under different economic conditions, making its policy decisions more predictable and transparent. Strengthening international coordination mechanisms with other central banks could also help mitigate the negative spillovers of divergent monetary policies in different jurisdictions. Ultimately, the Fed's policy framework is evolving in response to unprecedented economic challenges. People will say nobody knew tariffs were coming, so these are things that they have to look at, requiring flexibility and clear communication and a willingness to adapt to new realities while remaining committed to its core man. I ultimately think being cautious is the right decision because you don't want to cut rates and you find that the data tells you something completely different. Our next topic is on cryptocurrency policy innovation and particularly the Genius Act regulation that got passed shortly in this month of June. It's a groundbreaking development and in the digital asset space. The Senate 68 to 30 passage of the Genius Act on the 17th of June represents the first comprehensive federal framework for cryptocurrency regulation in US history. And this is something I believe I should do a deep dive on. This particular legislation establishes regulatory guardrails for stablecoins while maintaining innovation incentives through a dual oversight structure. The framework allows stablecoins issuers to choose between federal and state regulation, with state oversight limited to entities with $10 billion or less in issuance. Critical provisions require one-to-one backing with highly liquid assets and mandatory monthly audited reporting, which I think is really good. The Act introduces unprecedented enforcement capabilities through lawful orders, enabling Treasury and federal agencies to seize, freeze, burn, or prevent transfer of stablecoins in national security cases. And I think this is also quite important. Industry projections suggest this regulatory framework could enable the US dollar stablecoin market to grow eightfold to $2 trillion over the next decade, a significant step for the crypto world. And the key policy questions that I have when I consider this new Genius Act regulation, especially with the backdrop of other regulations that have been passed in other places, in other countries rather, is how effective does the dual oversight structure of the Genius Act balance the goals of fostering innovation in the cryptocurrency space with ensuring financial stability and consumer protection? Secondly, what are the potential implications of the lawful orders provision allowing federal agencies to seize, freeze, burn, or prevent transfer of stablecoins for individual privacy, property rights, and the broader adoption of decentralized digital assets? Thirdly, given the rapid evolution of the cryptocurrency market, how can regulatory frameworks like the Genius Act remain agile and adaptable to future technological advancements and emerging risk without stifling innovation? And when I consider these questions, I'd say that the passage of the Genius Act marks a pivotal moment in cryptocurrency revolution, not just in the US, but I think globally, because it sets the standard and it sort of gets other jurisdictions to start thinking of doing the same. It establishes the first comprehensive federal framework in the United States for stablecoins and the dual oversight structure, allowing issuers to choose between the federal and state regulation based on the issuance size. It's an attempt to balance the need for robust oversight with the desire to foster innovation. This approach acknowledges the diverse nature of stablecoin projects and aims to provide flexibility. The requirement for one-to-one backing with highly liquid assets and mandatory monthly audited reports are crucial provisions designed to enhance transparency and reduce systemic risk. Addressing concerns about the stability of stablecoins that have been around for a while and have arisen from the past, and I think it's quite valid because these measures are intended to build confidence in the stablecoin market, potentially paving the way for its projected eightfold growth, to $2 trillion in the future. However, the Act also introduces unprecedented enforcement capabilities through lawful orders, which allow federal agencies to seize, freeze, burn, or prevent transfer of stablecoins in national security cases. And I think this makes a lot of sense. However, where there are provisions like this, citizens also need to start to ensure that these provisions don't get abused. And I think, that's something that, from a policy perspective, yet it's good from a national security perspective. However, citizens also need to ensure that the rights they have don't get infringed upon, with this. And I think it's something that, we should take seriously. While it's intended to protect national security, the provision raises significant questions like I mentioned about individual privacy, property rights, and the fundamental principle of decentralized finance, being that not one person owns your access to your keys. Critics argue that such broad powers could be misused or deter legitimate innovation by creating an environment of regulatory uncertainty and fear. The challenge for policymakers will be to implement these powers judiciously and transparently, ensuring that they are narrowly tailored to address genuine national security threats without undermining the fundamental tenets of digital asset ownership. Also, the rapid pace of innovation in the cryptocurrency space means that any regulatory framework risk becoming quickly outdated is quite possible. The Genius Act, therefore, will need to be a living document, subject to continuous review and adaptation to ensure it remains relevant and effective in addressing emerging technologies and the risk that that could come while continuing to support reasonable innovation. The success of this legislation will ultimately depend on its ability to strike a delicate balance between control and freedom, fostering a secure yet dynamic asset ecosystem in the US and I dare say globally. Now, coming to our final topic, being the golden share policy as a tool for industrial policy. Now, we'll examine the new approach to state intervention, that we noticed in the just completed Nippon Steel $14.9 billion US Steel acquisition on the 18th of June. It introduced America's first golden share mechanism, thereby granting extraordinary governmental control over this private entity without financial investments. Now, this arrangement provides the US government veto power over strategic corporate decisions, including plant shutdowns, production cuts, job relocations, and future acquisitions. This represents a new approach to state intervention, and that maintains market-based ownership while ensuring government influence over strategic decisions. Unlike traditional nationalization, the golden share mechanism requires no government financial investment and provides no economic return to the state. It does, become important to mention that the golden share model offers significant applications for other countries seeking to balance foreign investment attraction with national security protection. Emerging economies could implement similar arrangements in telecommunications, energy infrastructure, defense manufacturing, and critical minerals processing sectors. And for me, the key policy questions when I, saw this happen not too long ago was, what are the potential benefits and drawbacks of employing a golden share mechanism as a tool for state intervention in strategically important industries, particularly concerning its impact on market efficiency, investor confidence, and corporate governance? Secondly, how does the golden share model compare to other forms of state intervention, such as nationalization or direct subsidies, in terms of economic efficiencies, political feasibility, and the potential for moral hazard? Also, what criteria, rather, should governments establish to determine when and in which sector the golden share mechanism is an appropriate policy tool? How can transparency and accountability be ensured in its application to prevent abuse or undue influence? The introduction of America's first golden share mechanism in the Nippon Steel US Steel acquisition represents a significant innovation in state intervention, offering a middle ground between unfettered market operation and outright nationalization. The primary benefit of a golden share is its ability to grant the government strategic control over critical corporate decisions, such as plant closures or job relocations, like I mentioned earlier, without requiring direct financial investment or ownership. Now, this can be particularly attractive in sectors considered vital for national security, economic stability, or critical infrastructures, allowing governments to safeguard national interests while still encouraging private sector investment and market-based operation, which is what we saw with this particular acquisition. Now, from an economic efficiency perspective, the golden share can theoretically reduce distortions associated with full nationalization of the entity or the business, as they do not remove the profit motive for the competitive pressures of the market. They also avoid the significant financial outlays and the potential for political interference that often accompanies direct state ownership. However, there are noticeable drawbacks, and I think we should sort of touch on that. The existence of a golden share can deter foreign investment, as it introduces an element of government discretion and potential interference that investors may perceive as a risk. And that is true. It can also complicate corporate governance, creating a dual power structure where the government holds a veto over certain decisions that make business sense, but not necessarily national, interest sense. Now, potentially leading to inefficiencies or conflicts with the interests of other shareholders or stakeholders. Compared to other forms of state intervention, the golden share is less intrusive than nationalization, but more direct than mere regulatory oversight. It does offer a flexible tool or policy tool, rather, for government to exert influence without the full burden of ownership. However, the potential for moral hazard exists if companies come to rely on the implicit backing, of the state due to the golden share mechanism. It also establishes clear, I would also say, to provide context, establishing clear criteria for its application is important to prevent, abuse of that particular mechanism, because, governments must define what exactly constitutes a strategic industry and ensure transparency in decision-making process, while using that golden share mechanism, so that you have accountability mechanisms in place that ensure that, you don't have favoritism or prevent political rent-seeking behavior that can come from, having state interest. Now, the golden share model, while innovative, requires careful implementation, like I mentioned, and robust, significant, how I put it, robust governance framework to ensure it serves its intended purpose of balancing the national interest with market principles rather than becoming a tool for, arbitrary state control. Now, having considered these 8 topics or 8 developments in the month of June 2025, it does show a global economic landscape that's characterized fundamentally by divergent approaches to persistent challenges of growth, inflation, and financial stability. The ECB's continued monetary accommodation contrasts sharply with the Federal Reserve caution, while Argentina's orthodox stabilization, success story does come with challenges. Against, conventional wisdom as to, why it doesn't always work. And, sort of pair that with, the economic adjustment that's to come and the sustainability of the stabilization program that we have in Argentina. You then find the emergence of new regulatory frameworks for digital assets, as we've seen with the Genius Act and the new state intervention mechanism in the US, with the golden share mechanism that we just talked about. It suggests that traditional boundaries between market mechanisms and government control continues to evolve in response to technological change and geopolitical pressures, that we seem to encounter in these times. At the backdrop, and you also consider the IMF's projection that this particular decade will experience the weakest growth since the 1960s, it does underscore the urgency of these policy innovations. And I'd say, it's been tremendous, exciting, June so far in terms of, the policy landscape. And I'll say that's all for these week's Policy Pulse. Join us next time as we continue to decode and break down, review policies shaping our world. Thank you for listening.